What's happening, traders? Welcome to another video. It's Emmanuel from Live Free FX here. Today, we're going to be diving into a trading concept that when I understood gave me so much perspective in the market. In my current trading, it's probably one of my biggest price action edge. And ladies and gentlemen, that concept is the concept of liquidity. In this video, I'm going to be going over what liquidity is, right? Some of its misconception in modern trading education and how you can identify areas of liquidity on your chart. Let's waste no time. Let's jump right into the video. Before we go over to the charts and identify areas of liquidity and how you can spot them, one of the very first things I want to dive into is what is liquidity and some of its misconceptions. So, liquidity. What is liquidity? Liquidity is how easily an asset, a currency pair, or even a stock can be bought or sold without any significant changes in its price. And when a trading or when a currency pair, for example, has a lot of trading volume, we call that very liquid. We say it's very liquid. And this brings me to it. What I want you to understand when you think of liquidity, guys, is money, because that's simply what liquidity represents, right? In the market, the number one language that is spoken is money. Commercial traders, the banks, the reason why the financial market is here today is because of the transactions that are made by these big institutions and just day-to-day business worldwide. So the concept of liquidity originates from money coming into the market. And the more money that flows into an asset or currency pair, for example, the more movement, the more volatility, the more volume, right? The more liquid that currency pair will be. And this brings me to the misconception that I'd like to address, because when a lot of traders hear liquidity, they instantly think smart money concept. And I have nothing against smart money concept. I actually think that some smart money concepts are very great, right? Once you start to understand it. But liquidity is not a smart money concept, guys. Liquidity is not an institutional concept. Liquidity is a foundational aspect of price action. It is one of those concepts that was made to seem like, oh my God, you got to be like a smart money trader. It's not one of those. So let's go over to the charts and dive into how you can identify areas of liquidity and the main concept that I use to do it effectively. When it comes to identifying areas of liquidity in the market, a concept that I like to use is the concept of buyers and sellers. Price moves in three ways, right? You have a consolidation market, which is pretty much a very low liquid market. There are orders being accumulated, right? There's liquidity coming into the market that hasn't been distributed yet. So consolidation markets are not very liquid markets. But when the liquidity flows into the market and the money starts to come in, it will either flow to the upside or to the downside. And let's just say buyers come into the market and liquidity is flowing to the upside. What are buyers doing? Buyers are making high highs and high lows. High highs, high lows, high highs, and high lows. But what buyers are instinctively doing, ladies and gentlemen, is that they are targeting the highs. The highs are being targeted. And for those of you guys who don't know this, liquidity is never here, right? At the candlestick, the liquidity is always residing at the high and at the low. That's where liquidity is, because there are a lot of orders that come into the market, right? Traders are placing their take profits at these levels. Traders are placing their stop losses at this level. So ultimately, the highs and the lows are just areas where the institutions, the big players, they target. And as a retail trader, even you do the same thing too, right? So these levels are extremely important, because if you are taking a trade right now, let's say you are buying, right? The market drops, maybe dips down here. Where are you going to place your stop loss? You're likely going to place your stop loss at this level here, right? You're going to place your stop loss at this low. And you're going to be looking for price to continue moving higher. But when sellers are coming to the market now, because they understand that there are stop losses at this level, your take profit will also be at this level as well. So sellers now begin to target the lows from the previous buyer's market. So as a byproduct, that is the war between the buyers and sellers, because they're both taking the liquidity that was left behind, or their own liquidity. The buyers target the highs, and sellers, they target the lows. And that's just simply how it works. So when you're thinking of liquidity, always remember, liquidity is always at the high and it's always at the low. If it's a buyer's market, the liquidity you should be targeting is at the high. If it's a seller's market, you should be looking to the left and trying to target the liquidity at the low, because this is where price is likely going to gravitate towards. So if we take a look at this market right now on gold, what we can see is we have a downtrend currently in play. Sellers were dominant. So what that meant is the liquidity to the downside is what sellers have been targeting all the way through. And as you can see that the lows were being targeted. And every time the low gets targeted, right, you get some sort of pullback. And you see this right here happen. Okay, price took out, let's make this slightly bigger. So price took out the low right here. We get, you know, a candlestick that pulls back, and then ultimately we get the big breakthrough. So sometimes you get a bigger pullback, sometimes you get a smaller pullback, but ultimately it all depends on how significant that low might be. And what we see here is simply the same thing. So in a seller's market, price is targeting the lows, and as a trader, when you are selling, right, this is just where the liquidity is residing. These levels, right? These levels are where you're looking to target. That's where the money is, because this is where the stop loss is. This is where the take profit is. There's a lot of orders residing at this level, which make them important areas of liquidity. And the most important thing too is probability. As traders, we deal in probability. We don't deal in certainty. So when you are asking yourself which area of liquidity is price going to be gravitating towards, or you're trying to identify an area of liquidity that price will be reaching for, it's important to understand that you're in the seller's market or you're in the buyer's market. And in this case, we are in a seller's market. So the probability of price targeting the liquidity at the high is a lot lower than the probability of price targeting the liquidity at the low, because when sellers are in control, they target the lows. So these areas of liquidity become the areas that you want to focus on. If you're looking for a reliable broker, whether you're a seasoned trader or a beginner trader, I trade with Hankotrade, and guys, they are one of the best in the game. With low spread, great customer service, free withdrawals, and overall great platform. They're also available on MT4 and MT5. For more information, check out the description below. And what we started to see here is more buyers started coming into the market. And as a byproduct of that, buyers started to target the liquidity at the high. And what you see here is boom, right? Price took out the liquidity at the high, creating the lower low. And as a trader, your objective is, okay, if buyers are going to continue coming to the market, this area is going to be the next area of liquidity, as well as this high that was formed. So if we take a look to the left now to see where price is currently at, right, we can see that we have now fully formed into a buyer's market, right? We have price creating higher highs and higher lows. So as a trader now, you are looking to identify areas of liquidity on the chart. So the question you ask yourself is, where is price likely going to go next, right? Because the market will flow where liquidity goes. In a buyer's market, buyers are targeting the highs because this is where the liquidity is. So if you're a seller, you're placing your stop loss right here and taking advantage of the short-term price movement. And if you're a buyer, you're placing your take profit right here, taking advantage of, you know, the buyer's market. So a lot of orders residing at this level. So personally for me, the probability favors being a buyer. And what this does is it gives you an insight to what the big players are doing, like the institutions, the commercial traders, and the banks, right? Because if buyers are in control, they are targeting the high. So as a byproduct, when liquidity flows in the market, it's likely going to be reaching for this level. So what you do when you identify areas of liquidity on the chart is you just simply map out areas of liquidity that hasn't been tapped yet. And we know that we have this high that price is likely going to be reaching for. And if we get a big enough move in the market, or price moves really well, there's a possibility that we can even see, this high or this area of liquidity tapped as well. So that's simply what you do. The first thing is you identify the trend, right? You take a look at the market structure, who is in control of the market, right? And based on who is in control of the market, you use probability, because that will tell you if you're in the seller's market, sellers are reaching for the lows. If you're in the buyer's market, buyers are reaching for the high. And as I said earlier in the video, liquidity is never residing in the middle right here or in a candlestick right there. Liquidity is always residing at the high and at the low. In this trade scenario, we've mapped out our areas of liquidity. Now we're just going to simply watch and see what price does, and just see if the market hits our area of liquidity. Perfect. So when an area of liquidity has been tapped, we're likely going to see price pull back. And guys, this is very simple. The concept of buyers and sellers when it comes to identifying areas of liquidity on the chart is one of the most effective to use. It's easy to understand, and as you can see here, it is just a byproduct of how price moves, and this is just how you do it. The most important thing to keep in mind is liquidity is always at the high and at the low. And that's the video, ladies and gentlemen. Hope you found it insightful. On your way out, don't forget to hit that like and subscribe button. And as always, hope you're out there living free. I'm cheering for you. Peace.